Did you know that a few simple tax moves could save you hundreds, if not thousands of dollars come tax time? With new tax brackets, a higher standard deduction, and changes to the IRS reporting, this year's tax season has a few surprises and some costly mistakes you'll want to avoid. In this video, I'll walk you through the essential steps you can take now to make sure you're not leaving money on the table or caught off guard by the IRS. Whether you're a seasoned filer or tackling taxes on your own for the first time, I'll break down what's changed for 2024 and give you a straightforward action plan to get you organized before the year's end. From updated deductions to important new 1099-K reporting rules, this is the information every taxpayer needs to know to be ready for the upcoming tax season. Hi, I'm Noel Lorenzana. My channel is about simplifying taxes, business, and alternative economic insights. Let's dive in. Let's start with the basics. Tax brackets and the standard deduction. The IRS adjusts these each year for inflation, and for 2024, we're seeing some changes that could impact what you owe or even bump you up into a different tax bracket. Here's what you need to know. The new standard deduction. For single filers, the standard deduction has gone up to $14,600, and for married couples filing jointly, it's $29,200. For head of household, it's $21,900. This is about a 5% increase from last year and means more of your income won't be taxed, which is a good thing. Now, if you're someone who itemizes your deductions, there's good news. Nothing major has changed, the same rules still apply, so you can keep using your usual deductions without any surprises this tax season. Next up, the IRS updated their tax brackets. Tax rates remain the same, but the income thresholds have shifted upwards, adjusted for inflation. On average, a 5% increase. For example, if you're filing single, the 22% tax rate now applies to income over $47,150, whereas last year it was lower. Adjustments like these can influence how much you ultimately owe or get back. Looking at the table for married couples, you can see that the tax rates stayed the same, but the income levels they apply to moved up around 5% as well. Now's a great time to check where you fall in the updated tax brackets. It could be worth planning contributions to things like retirement accounts if you're close to moving up a tax bracket. Real quick, let's talk about tax brackets and clear up a big misconception. So you only pay each tax rate on the portion of your income that falls into that tax rate bucket, not on all your income. Here's what I mean. Think of tax brackets like a series of buckets, each one with a different tax rate. As your income fills up one bucket, the overflow spills into the next bucket at a slightly higher tax rate. You're only taxed at each rate on the income within that specific bucket, not on your entire income. For example, the first bucket for single filers covers income up to $11,600 and is taxed at 10%. If you make $12,000, for example, only that extra $400 that spills into the next bucket is taxed at the 12% rate, not the full $12,000. I hope that helps, and I hope that makes sense. Moving on, one major update this year is the new 1099-K reporting rules. If you remember last year, they had a lot of changes, and these changes will affect a lot of people, especially if you're self-employed, sell stuff online, or even get paid for side gigs. What's changed? Originally, the IRS planned to lower the 1099-K reporting threshold to just $600, meaning anyone receiving payments over $600 through these third-party payment platforms like PayPal, Venmo, Cash App, but not Zelle, would get a 1099-K form at the end of the year. But this year, that's been delayed, and the threshold is set at $5,000. So if you received over $5,000 in payments through any of these payment platforms in 2024, you'll get an IRS Form 1099-K, and you'll need to report that income on your tax return. If you don't, you'll get a nasty letter from the IRS. Why it matters. The 1099-K is different from other tax forms. It's an informational form, and it reports gross income before fees, refunds, or adjustments. So it's essential to keep good records because the IRS will see the full amount you received, even if it's not your net income. So just to be clear, gross income is before taxes and fees and other things like that. Net income is the net amount after you subtract out all the deductions, fees, refunds, whatever. Missing expenses or deductions could mean paying more than you actually owe. So getting your income and expenses right is crucial so that you don't overpay on your taxes. By the way, I've got a great bookkeeping mini course on this very subject, which you can check out up here. So if you're expecting a 1099K, now is a great time to gather any records or business expenses, fees, or refunds associated with that income, or at least know where to get it when the time comes. Keeping good records will help you accurately report your net income so you're not paying any more in taxes than you legally owe. One other thing, you can still get a 1099K if your gross earnings are less than $5,000. It's because some states have already adopted the $600 reporting threshold. So if you're in one of those states, don't be surprised if you receive one. And also don't forget, I mentioned this earlier, the payment platform Zelle is not subject to 1099K reporting. Let's talk about some year-end tax moves to consider. Some smart moves you can make before year's end to reduce your tax bill and start your 2024 taxes off on the right foot are the following. Number 1, max out your retirement contributions. If you have an IRA or a 401k through your employer, consider maximizing your contributions. Not only can this lower your taxable income, but it also helps to build up your retirement savings. And if you're 50 years of age or older, you can make additional catch-up contributions to boost those savings even more. Number 2, review charitable contributions. If you're planning to make charitable contributions, be sure to do so before December 31st. Donations to qualified charities can be reduced on your tax return if you itemize, which can lower your taxable income. Now, one thing to note is that if you don't itemize your deductions, you can't take advantage of the charitable contributions. That is because the standard deduction would be higher, and you would use that. So one strategy is you can bunch up your deductions, and maybe for 2025, that would get you enough deductions so that you could itemize. Something to think about. Number 3, check your withholdings. If you receive a raise, changed jobs, or had a major life event this year, it's a good idea to check your withholdings with your employer to make sure you're on track. Adjusting your W-4 now can help you avoid a surprise tax bill or ensure you don't overpay. Number 4, consider tax loss harvesting. If you have investments, look at any losses you can harvest to offset gains. This strategy called tax loss harvesting can help reduce your taxable income. Just remember, this can get a bit technical, so it might be worth consulting a tax professional if you're unsure. Number 5, gather your records early. As the year winds down, start collecting important tax documents like your W-2s, 1099s, and receipts for deductible expenses. I like to put them in a folder. I label it 2024 tax documents and just collect the documents as the year goes by. Having everything ready can make tax season much smoother and reduce the stress of last-minute scrambling. Taking even a few of these steps can make a big difference in reducing your tax liability and getting prepared for the new year. Taxes don't have to be overwhelming. With a little planning, you can tackle them with confidence and save yourself time, money, and stress. I also wanted to cover something important which doesn't directly affect 2024, but it's a major change for 2025 that you need to be aware of now. And that is the sunsetting of the Tax Cuts and Jobs Act, or TCJA. This is set to expire at the end of 2025. While the changes don't affect your 2024 taxes directly, it's worth understanding what this could mean for your future tax planning. I just need to add that since Donald Trump won the presidency and it's looking like the Republicans might also control Congress, it's very well possible that President Trump extends or makes permanent the Tax Cuts and Jobs Act. In my opinion, this is a good thing. It lowered and simplified taxes for most Americans. Hopefully, the state and local tax limitation of $10,000 is removed. Nevertheless, be sure you're subscribed so you don't miss any important updates. What's changing? The Tax Cuts and Jobs Act, if you recall, brought in a number of benefits for individual taxpayers, like doubling the standard deductions, lowering tax rates, and doubling the child tax credit. But these provisions are temporary and are scheduled to expire after 2025. That is, unless Congress takes actions to extend them, and right now that's unclear. Why this matters now? Knowing these changes are coming can help you plan ahead. For example, the standard deduction may drop and personal exemptions might come back, which could increase your taxable income. This is especially important if you're trying to maximize your current deductions or contributions while tax rates are still relatively low. Because of the Tax Cuts and Jobs Act, many people were taking the standard deduction. After it expires, many will go back to itemizing deductions. So if you itemized pre-Tax Cuts and Jobs Act, you have some tax planning opportunities going forward. What you can do now. For 2024, take full advantage of the current TCJA benefits like the higher standard deduction and the available credits. It's also a good idea to start thinking about your tax strategy for future years, especially if you're expecting changes to your income or expenses that could push you into a different tax bracket down the line. Thanks for tuning in. If you found the video helpful, hit that like button, consider subscribing, and feel free to check out my other videos for more practical tax tips. As always, reach out with any questions. Thanks for watching and see you in the next video.